Did you know that Netflix spent over $17 billion on original content in 2023 alone? That's more than the GDP of some small countries. But here's the bigger question. Is it sustainable? And more importantly, what can finance students learn from how Netflix manages and justifies such massive investments? In today's video, we are breaking down the financial implication of Netflix original content strategy and extracting real-world lessons for finance students like you. And let's dive in. Netflix operates on a subscription-based model with a focus on direct-to-consumer distribution. Unlike traditional media, it doesn't rely on box office, sales, or cable packages. The key revenue stream? Monthly subscriptions. So, why does Netflix keep investing billions in original shows and movies? Because content is what keeps users subscribed, and original content creates exclusivity which boosts retention and reduces churn. Netflix has been increasing its content budget year on year. In 2016, it spent around $6 billion. By 2023, that has jumped to $17 billion. This aggressive spending goes into licensing, production, distribution rights, and even global dubbing and localization. But all of this is reflected on their financial statements, and that is where it gets interesting from a finance perspective. Here's core concept. Netflix treats original content as capital expenditure, not just an operating expense. Let's break it down. When Netflix produces a show, the cost is first capitalized as an intangible asset under content assets on the balance sheet. Then, as users consume it, Netflix amortizes that cost over a period of time, usually based on viewership data. This strategy allows Netflix to spread the cost of content over its useful life rather than taking a hit all at once. Now that's a key takeaway for finance students. Learn how companies use accounting treatment to manage earnings, cash flow, and investor sentiment. Netflix has also relied heavily on debt to finance its content production. Between the year 2016 and 2020, Netflix raised billions through bond issues, betting that subscriber growth would offset the risk. And at one point, its debt to equity ratio was well above 1, a red flag for conservative investors. Yet, because of strong cash flow, improving margins, and confident forecasting, Netflix managed to maintain investor trust. Here's the lessons for finance students. Understand how companies use leverage strategically and the importance of forecasted cash flows in justifying high debt levels. Of course, not every show is a hit. Netflix has to deal with high sunk costs, volatile returns, and intense competition from Disney+, Amazon Prime, and others. That's where risk-adjusted returns come in. Finance students should understand project evaluation under uncertainty and how companies justify spending using tools like net present value, NPV, internal rate of return, IRR, payback period, and scenario analysis. Each show is essentially an investment, and Netflix is playing a portfolio game, betting that a few big hits like Stranger Things or The Witcher will cover the cost of the flops. So, what are the key lessons for finance students? Number 1. Learn how intangible assets are accounted for and authorized over a period of time. Number 2. Understanding the balance between operating cash flow versus free cash flow. Number 3. Study how debt financing is justified in high-growth businesses. Number 4. Analyze risk versus reward through capital budgeting tools. And lastly, number 5. Think like a CFO. How would you defend a $200 million series investment to investors? Netflix gives us a front row seat into the modern corporate finance, from valuation and investment strategy to perform metrics and stakeholder communication. At Finplan Edu, we help finance students decode real businesses decisions like these, not just from a theory point of view, but how they apply in the world's top companies. If you'd like to sharpen your finance analysis skills with real-world case studies, feel free to reach out or explore our courses. To wrap it up, Netflix investment in original content is a high-stake, high-return strategy that blends creativity with deep finance planning, and as a finance student, there's no better way to learn than by watching how the world's biggest company manage risk leverage and value creation. If you found this breakdown insightful, make sure to like the video, subscribe to the channel, and drop a comment on which company we should analyze next. Thanks for watching and see you in the next one.